Welcome, dear traders. You are watching a recap of the Asian session on October 3. Global equity markets continue to see diminishing risk appetite. The Asia-Pacific region is following this trend, along with the Wall Street futures. Stock market indicators in Japan and the antipodian countries also started to sell off in the red territory today. Asian stocks are falling amid rising treasury yields and a stronger US dollar. In addition, Asian equities and currencies are being influenced by domestic data. Notably, the Fed remains the main factor that affects the region's markets. The fresh statistics revealed that the US economy was withstanding the regulator's aggressive policy decisions. Given the hawkish stance of global central banks, stocks are likely to continue to move in a bearish trend. Today, investors are trying to find more insight in the comments of Fed speakers. Yesterday, Fed Governor Michelle Bowman said that she was still ready to support another rate hike. Michael Barr, the Fed's vice chair for supervision, emphasized a cautious approach to monetary policy. Furthermore, news is fresh that US lawmakers reached a tentative agreement this weekend. The US government will be funded for another 45 days until November 17, and the US dollar continued to strengthen on these years. As a result, the US dollar index climbed above 107 early Tuesday, and the yield on the 10-year US Treasury bond soared to its highest level since 2007. Strong economic reports explain the greenback's optimism. The fresh US data reinforces the view that the Fed will be able to keep interest rates high for longer. While investors await new reports and fresh comments from Fed speakers this week, the greenback is strengthening even more. Traditionally, traders higher in Asia. Today, bulls are pushing the US currency to the upper boundary of the 106.90 and 107.20 range. As a result, the greenback is hovering around multi-month highs against the euro, pound and the yen. While the dollar benefited from reduced investor appetite for the safe haven currency, the yen weakened significantly. In early Tuesday trading, the yen had a tumultuous session in the range of 149.16, 149.90. On the chart, the dollar-yen pair almost tested the critical level of 150. Considering that Japan's authorities relentlessly monitor the dollar-yen exchange rate, they may have stepped in and made a physical intervention in the forex market. In addition, the Bank of Japan often buys government bonds to stabilize the financial markets. At the same time, there were verbal interventions again on Tuesday. Japanese Finance Minister SHUNICHI SUZUKI reiterated that the authorities were closely monitoring the currency market and were ready to act in the market. At the same time, the official clarified that the intervention would not be aimed at a specific price, but depend on volatility. Notably, markets have been waiting for an intervention for several weeks. Meanwhile, Asian markets see some positive signals from China. Manufacturing activity in the world's second-largest economy expanded in September for the first time in 6 months. Retail sales also rose and deflationary pressures eased. Most likely, the Chinese economy has reversed and is starting to grow. The World Bank has downgraded its forecast for China's GDP growth in 2024, although East Asia and the Pacific remain one of the fastest growing regions in the world. Ongoing domestic challenges, including weakness in the real estate sector, rising debt, and an aging population will negatively impact China's economic performance. In any case, Japan, Australia, and New Zealand, China's main trading partners, may benefit from even a modest improvement in China's economic outlook. Meanwhile, the Australian economy has been stronger than expected in the first half of 2023. This is despite a number of headwinds at home and abroad, mostly from China. The Reserve Bank of Australia left the prime rate unchanged for the fifth consecutive meeting. As a result, the Aussie dollar pair came under pressure from all sides during the Asian trading session, and the Australian currency approached an 11-month low and fell to 0.6320. The Aussie is slumping on a negative news about China's GDP, falling risk sentiment, and lower crude prices, and the pair closed Tuesday's Asian session in the bearish territory within the range of 0.6305 and 0.6371. The New Zealand dollar closed the Asian trade at 0.5904. The meeting of the Reserve Bank of New Zealand will be held tomorrow. However, judging by the Kiwi's reaction, the markets are not expecting a rate hike. Today, the currency is sensitive to external factors. They are mostly negative for the New Zealand dollar, as well as for its American counterpart. As a result, the Kiwi traded lower between the resistance of 0.5955 and the support of 0.5904. And that's all for now. Leave your comments below and don't miss our next video review. Remember that staying up to date is the key to success in your trading. See you online soon.